get started. Today's Women in Risk session on environment is the last in a three-part series on ESG, or environment, social, and governance issues facing the financial sector. Risk management is about helping organizations navigate through uncharted territory, developing systems to ensure greater stability and prosperity, and adapting to the complexity and diversity that defines the business context in the world today. The role of those working in risk management today has evolved beyond areas of traditional financial risk and into those as diverse as cybersecurity, geopolitical upheaval, and climate change, which we're going to do a deep dive on today. Our Women in Risk series was developed to build risk management capacity in areas of emerging risk and address the talent and gender gap in the field. Without further ado, I'm very pleased to introduce our two guest speakers today. Feel free to come online with your videos. They're coming up. We've got Amy West, Managing Director and Global Head of Sustainable Finance and Corporate Transitions at TD Securities. She works with corporate and institutional clients across global banking and markets to provide environmental, social, and governance, or ESG, advice and solutions. Prior to joining TD in 2013, Amy worked at several other global financial institutions in investment banking and debt capital markets. And Miranda Hubbs, she's board director of three companies, Nutrien, Imperial Oil, and PSP. She gained her depth of knowledge in these sectors through her career as an energy investment banker and executive vice president with McLean Budden and Gordon Capital. She currently serves as vice chair of the board of the Canadian Red Cross. So let's dive into it. The Canadian government has joined over 100 others, including the US, China, and the EU, in setting a net zero by 2050 carbon emissions reductions target, with an interim target of cutting carbon emissions by 40% below 2005 levels by 2030. That's only 9 years from now. They're doing this because if they don't, scientists have predicted that business as usual greenhouse gas emissions will lead us to at least a 3°C temperature rise by the end of the century. And that brings with it the disruption of the world as we know it, from increased storms, fires, floods, to droughts and other chronic changes in the way our world works. But GDP growth and greenhouse gas emissions have been closely coupled for the last century. This decoupling has not been attempted before on this scale and will require entire system transformations in transport, infrastructure, agriculture, and energy, to name a few. Miranda, you've got deep knowledge of two of these key pillars, or three of the key pillars in our economy: finance, but also agriculture and energy. These are the source of essential goods and services humans need. We would love to be a fly on the wall of some of the strategy conversations you're having in those sectors about what the next 30 years look like. Are the discussions about adapting to a changing climate, or about transforming and remaining competitive in a low carbon future? Miranda.
Well, thanks for that. Let's just start with the basic belief that businesses cannot succeed in societies that fail. So we do need to reduce emissions. Everyone's embraced that. We talk about the challenge of net zero by 2050, but we don't talk about the challenge of feeding 10 billion people in 2050, and also ensuring that that 10 billion people have access to both reliable and affordable energy. So companies are really trying to balance off all of these needs of what has to be done to fulfill their purpose, while at the same time integrating net zero into that strategy. So yeah, look at what's happening. We're trying to influence behaviors, from internally and from a customer and supply chain standpoint. They're trying for efficiencies within their processes and their products, and there is a lot of spending and piloting of new technologies. And we talk about net zero 2050, and we'll talk a bit about targets, I think, today, I'm sure. The battle around the tables these days is, do you put a net zero 2050 target on the table when you have no idea how you're going to achieve it? Or do you look at smaller, more incremental, measurable targets that you know how to deal with today, with the thinking that the technologies will evolve over the next decade to get us to where we need to be? and that we need to spend the time on all of these issues, whether it's the customer behaviors, the efficiencies, and the technologies to get us to that stage. And all this goes on while you're trying to balance what your stakeholders are requiring of you, and not the least of which is, you know what, that's all nice. We want you to do all these things, and at the same time, we want our dividends.
Yeah, exactly. Thank you, Miranda, for setting the stage. Amy, financial firms are under pressure to play a major role in driving a low emissions economy and providing capital to help firms reduce carbon emissions or to invest in the growth of the green economy. I mean, TD was one of the first Canadian institutions, and I think the first bank, to declare its net zero operational and portfolio emissions target. Can you bring us behind the scenes a little bit on how you got there and what the priorities are now and what the big milestones are for the next, say, 2 to 5 years?
Sure, absolutely. And it's a great question. And a lot of what we were discussing actually mirrors what Miranda was just commenting on, which is the real decision point, the inflection point that brought us to the market in terms of making a net zero announcement was that for us in our discussions, it became not a question of if we were going to be making a net zero announcement, but when. And so if the question becomes when, we saw a lot of intrinsic value, both in our business lines, but also in our internal processes of being at the forefront of that. And so we made our announcement last November. It was for all three scopes, but something Miranda commented on, I think, weighed heavy on our psyches and our discussions, which is you're making a net zero 2050 target. And one of the big pushes from the NGO community has been, we'll make an interim target, make a 2025 target or 2030 target. And we were sitting there saying, well, hold on, you want us to make a target for our scope 1, 2, and 3 emissions. And we're a financial institution that actually has been operationally net neutral, carbon neutral since 2010. So we have a very good handle on our scope 1 and 2, but we have absolutely no idea what the baseline for our scope 3 is. And so how do you expect us to make a net zero interim target when we don't know the baseline we're working from? And so we actually made the announcement. We did not give an interim target. We thought that that was the prudent thing to do, given that we didn't know our baseline. And we actually had significantly less comment or blowback from the public than we expected on that front, which was an acceptance. And I think part of it was just that we decided as an institution to be extremely open and transparent about the fact that you can't ask an interim target on something that we don't know the starting point for. And so I agree with a lot of what Miranda's saying. That's how we decided to come to market, and those were the big pushes. And then on the business side, I'll be remiss if I don't say we do feel like we've been put ahead. We're 6 months into this. We're just starting to understand. We worked with S&P TrueCost what some of our emissions information is. I'll be frank, there's a lot of assumptions built into this work.
Yeah.
We're all figuring this out institutionally as we go. I think as an industry, we're figuring it out as we go. But we do think that it puts us on the forefront of what's happening here. And we have a number of clients asking what it means. It's hard to imagine that you're in the risk management seat at a company today and you haven't noticed that all the major North American financials have made net zero commitments. So being able to understand what that could mean for our clients, I think is key going forward.
Amy, do you think there's a different requirement on the financials versus the high emitters?
I think there will be. I get this question a lot. Where does net zero mean everyone goes to net zero? Because these are societal commitments. These are policy commitments.
Yeah.
I think that my perspective on that, and I tend to be a bit of a pragmatist here, is that it means that all sectors need to perform. This isn't a conversation solely about energy. So maybe you have, and I'll look at Microsoft as a great example. Microsoft is not just going to net zero, they're actually removing historic carbon because they are uniquely positioned to do more. We're going to need all sectors of the economy to improve. That's going to take every province, that's going to take every business, and some are going to need to do more than others. I actually will say, though, in my discussions, I find energy incredibly well prepared. All of our hard to abate sectors are really well prepared for this conversation because they've been under focus for a long time. I think they're actually more well positioned than a lot of other sectors, if I were to give sort of a personal opinion on it.
Yeah, I'd agree with that scrutiny, and I think also, but it also leads to that. Would they let the large emitting, the hard to abate sectors, put a 2050 target with no plan? versus
Well, it's
saying,
interesting,
yeah,
right?
right?
Because just last night,
Mhm.
Conoco, yesterday, I should say, ConocoPhillips had a shareholder resolution passed with 58% that they now need to declare their Scope 3 emissions and have a plan.
Mhm.
And that was interesting because I don't know how many people noticed, but they actually went to the SEC and tried to remove that shareholder proposition from the ballot, and were effectively told they were not allowed to. So we are starting to see it creep up. I do think there's some value in being proactive versus reacting to a majority shareholder vote. Um, but I agree with you. Yeah, it's definitely
Let's
going to
jump
be.
into that engagement element because it's proxy season. We're seeing there's a lot of action going on in terms of shareholder resolutions. And in fact, over the last decade, so many of the shareholder resolutions have been focused on ESG issues and climate, maybe diversity being the other major source. So I guess I'm wondering, are you seeing these same sort of shareholder resolutions coming to the energy firms, Miranda, or is it because the banks are? I feel like they're in the spotlight, and on other asset managers, let's say, and investment firms, are we seeing the same amount sort of coming from investors, activist investors? How does it look?
Yeah, so it's interesting. I saw Say on Climate for the first time with Scottish and Southern, the
Yeah.
energy company, and that was, we thought, a big deal. And then CN also came out with Say on Climate. That is coming, I think, and it really speaks back to what we want to hear, what the plan is
Yeah.
from the investor base. But certainly that engagement, even before it's hit the proxy, it's the shareholders saying, meet with us, tell us what the plan is. And you know what? And they want some realistic numbers and targets. And it's interesting, because if we say, look, we don't know how today to get to net zero in 2050, but this is what we're doing to try to get there and make sure that we're ready to get there over the next decade. And you know what? We found that they're actually really good about that, because I think there is the acknowledgement that 30 years is a long time in technology world, right? Things change very rapidly,
Mhm.
and the transition is going to take trillions of dollars, and that's not just infrastructure; that is R&D as well. And both of them are material type of commitments, and it's going to require that industry collaboration, cross-sector collaboration. And you said it, it's not just one sector, it's not just one company, it's a societal issue. Some will do more, some will not be able to do as much, but we're going to have to find every different way, and there's going to be more than one way that companies are achieving these targets.
And Amy, you're kind of on both sides of the coin. You may be receiving shareholder resolutions. People probably, I don't know what you think your time frame might be, where people start saying, hey, we need to see more. We know you're reverse engineering back from that net zero. We want to see more details. I don't know what your time frame is. And on the same time, you might be engaging with some of your key clients on climate related. You need more information from them, or you want to see better governance, or why don't you tell us a little bit from both sides of the coin?
Yeah, no, I could not agree more. The proxy season is always interesting because proxy votes today become policy tomorrow. And it's actually fascinating. If you look back 5 years, a lot of what looked like extremely kindly, I'll say progressive, realistically, I'll say aggressive proxy,
Yeah.
proposals have actually become policy. There were things 5 years ago being asked for, simply GHG emissions. Please publish what your emissions are. Now you can't imagine being an energy company and not at least
Not published.
publishing your scope 1 and 2 emissions. So there, it is having an effect, and it is being positive. And we were actually discussing this on my team just this morning. If you are one of these share action or series type of issue, type of NGO groups, you have to be really encouraged right now. So I think if you're sitting as at a company, you have to expect there will be more, not less, of these
Yeah.
proposals going forward. I think Miranda's point's well made, which is that I share the viewpoint of being extremely positive on the rational thinking around this topic. When I meet with investors, when we speak with strategic buyers, whether it's to discuss equity capital raises, whether it's to do M&A, whether it's to advise on a benchmarking exercise for these companies, there is an implicit understanding that 30 years is a long time and that we don't have a perfect roadmap of how to get there. And I think once you understand that, transparency becomes king. Now, where I do think companies are going to have to adjust is that you are going to be benchmarked against your sector. I think there was a huge thought a few years ago, well, maybe I'll be compared cross-sector. Can you compare TELUS to Suncor? The short answer is no. Those are not fair comparisons. But what we can do is we can compare within sector. And so I do think there will be winners and losers within sector, because you're going to have sort of what the average expectation is within that sector. And there's going to be a question on who are your top quartile performers and who are your laggards. And right now, and this has been a big change in the past 2 years, as ESG very much becomes viewed almost without question as a material financial risk, you really are transitioning away from people that I would say are not paying attention. I think we've passed that point in time by. So now if you're choosing to not report on these things, it's usually intentional. And I think that also changes the conversation, because engagement's going to become critical. Right now, at least in the financial community, a lot of the engagement is actually quite positive. There's financial incentives being offered to companies. Investors are very clearly, whether they say it or not, willing to pay more for access to these types of initiatives and products. But down the road, it wouldn't be surprising to me to see it really start to change the availability of capital for clients that aren't responding.
I want to move to that product side in a minute, but before we move on, there's these couple of tactics I think that financial firms are using, investors and lenders are using to try to get better performance or information out of clients or issuers. One is the engagement, so that's a big one. On now, watch the proxy space. I think very exciting. Proxy becomes policy. I like how you put that. The other, from a risk standpoint, we might call it risk avoidance. In other words, divestment or exclusion. So we've seen this a lot, actually. Canada's been hit pretty hard by this, especially from European and foreign investors who are saying we no longer will lend to or invest in or underwrite activities in the oil sands in the Canadian energy sector because of its high emissions footprint. So this is one way that some are trying to reduce the carbon emissions of their portfolio, of their finance emissions. This is coming to the point where this is getting to be potentially a bit of a problem for Canada. This divestment space is so interesting. I want to hear both your perspectives on how effective is this as a strategy to both reduce your carbon emissions, but also maybe to help that industry reduce its carbon emissions, let's say. Is this an effective net zero strategy? I don't know which one of you wants to go first. I know you both have strong feelings on it.
Well, yeah, I'll try. So it's with respect to change, it's a very blunt tool. You're not affecting any positive societal change by divestment. So it's what's your end goal? From the perspective of overall risk, you would think that your process, because if we're talking about risk, it's your terminal value risk, right? That's what ultimately this is what it's leading to, right? That the emissions are going to result in zero terminal value, your stranded assets. So you would think that your process would lead you to that, and your process would take into account what the companies were doing in the transition space rather than where they are today. But again, you know what? They're entitled to do that. But again, I go back to you're not actually affecting change. And then you look at, and we'll talk about this a bit later about what messages are about risk. Are you actually reducing your overall risk? Are you just reducing your climate risk, or are you swapping one risk for another risk? And I think that you framed this at the beginning, Alison, very well, in the fact that it is diverse and it is complex. So by any credible scenario, by 2040, the fossil fuels still make up a very big part of our energy mix. We also know what decline rates look like. Does it make sense to starve this industry of capital when it's still going to be a big part of our future mix, or are we creating additional risks in that we're going to be scrambling to try to find and make sure that we have that reliable, affordable energy?
Yeah. And Amy, what's the perspective? I mean, that net zero target is sort of a beacon. No. What's the pathway?
Look, I couldn't agree with those comments. I think I agree with those comments. I should say I couldn't agree more. The bottom line here is that I don't think divestment is a logical step. I understand it's been taken by a number of financials, and it was very splashy. It gave a lot of positive headlines. But the reality of it is we're also talking about European banks that had such a little footprint in Canada. It was really irrelevant to their overall profitability of their businesses. It is an entirely different story when we look at the North American financials. And so there is no plan, at least at our firm, to approach divestment. That's not to say that it would never be a process, but we will never do a sectoral divestment. I don't think that that'll ever be part of the plan. But net zero doesn't mean that every company in every sector is going to be a going concern in 2030. I do think there will be, 2050. I do think there will be winners and losers. And so for us, divestment, you're leaving your seat at the table. You can't really impact positive change. And I think that that's not going to work. Every human being born today uses and will use over the course of their life more electricity than every human being that exists. And it's generationally aligned. And that is just going to be a reality going forward. Is the energy mix in 2035 going to look the same as today? No, it's not. But that doesn't mean that there's not a role to play for our existing traditional energy companies. Maybe they become more integrated. Maybe they actually have different offerings. Could CCS technology in Canada become a new business line and not just a way to offset their existing emissions? I think it could. So there's a lot of different iterations here that lead me down the path of thinking divestment doesn't make a lot of sense. But it's hard to separate those comments from the political bias. I mean, it was fascinating. Just last week, we saw Germany, as part of its sustainable finance plan, come out strongly in opposition to nuclear. Meanwhile, France, who has 70% of their grid being fueled by nuclear, is very obviously much in support of it. So it's not a surprise that even in Europe, where they're way ahead with a consistent regulatory environment for sustainable finance, where they have a big push for there to be more rules that are integrated, both natural gas and nuclear still under debate. They can't reach conclusion on it. So then if you look at North America, both the US and Canada have significant access to natural gas, significant access to nuclear and capacity for both. And so, will there be certain things like coal that may come under scrutiny? You've already seen some banks putting it there. That wouldn't be a surprise to me. But I do think just walking away from these industries is really a short-term solution. And I don't think it mitigates long-term risk.
Thanks. And sorry, I just want to mention, I'm glad you brought up it was PR in a lot of senses. This was not an economic decision as much as it is PR in a lot of cases. But you did bring up an interesting point as well around energy security and why certain companies are much more favorable to either nuclear or natural gas or other forms, because this is going to become in the future a bigger and bigger political discussion as you have certain countries that become much more reliant on imports. Do you want that? Do you want a grid that's reliant on one of your neighbors that you might not be getting along with politically down the road? What happens? What happens if they flip the switch and turn the lights off? So that we don't talk about that resilience enough either to a lot of these decisions.
So yeah, energy is very much intertwined with sort of geopolitical and other issues. But maybe one question: the divestment we've seen in the oil sands specifically, because it's often named as a sector, and there's only oil sands in one country, so that's pretty specific for Canada.
Actually, when they're targeting, they say tar sands, not oil sands.
Or tar, yeah. Have we
Very true.
yet? Like, are we at the stage? Because there's a lot. Are we at the stage where cost of capital is sort of changing or threatened by this, or has it really just been those players that weren't really all that majorly engaged? They weren't the primary players that are involved in that sector in Canada just yet. And or do you see in the next, say, 5 to 10 years, do you think that could be a risk? Could this be sort of a capital flight?
Yeah, we talked about those winners and losers, and the reality is a lot of those big players in the oil sands, they are standalone, profitable, investment grade type of companies. So then it becomes, does it make more sense for them to go private and not have to deal with the capital markets scrutiny? And again, does that solve any long-term solution or any long-term issues with respect to emissions or anything else if you're driving companies into hiding, basically, for another 5 or 10 years before we deal with the public markets and then start going after some of these private assets. So yeah, I think the short answer, yeah, it will affect cost of capital, but you know, a lot of these companies are throwing off so much cash, that's not their issue right now.
Right.
Yeah, and maybe I could actually answer that one as well. You know, I agree with Miranda that today I don't think that there's a big impact in cost of capital per se. I do think, though, that the availability of strategic capital when you go to sell certain things is changing rapidly. As our strategic investors, be it pensions, asset owners, or the like, have targets of their own, I think that it's going to be inherent upon these institutions to sort of differentiate. And I'll give you a very specific example. We recently were working on an M&A proposal where if you modeled out the company that they were looking to acquire, which was in the LNG space, you actually saw it as a very profitable enterprise. And in specific, one asset in particular had a long-term contract in place. And in the model, there was an assumption that when the long-term contract came off in, let's call it 15 years, there was still residual value to the facility. As we transition through this energy transition, maybe that residual value isn't what you think it is in year 15. And this is a real risk that we need to be pricing in. Maybe in year 15, that value is actually zero because we're dealing with an antiquated technology and it's a fossil fuel and the market is rapidly evolving to what they view as more renewable opportunities. Well, if you then take that value and you take it to zero in your model, how does that change the overall discussion? How does that change the risk return profile? It changes it materially. So that's the work we're just starting to do today. And that's where I do think that it may not be the cost of capital today, but the ability to do business as usual may change if you no longer have the strategic buyers on the other side.
Yeah, absolutely. No, it's a great example, a great case, and it also shows how the timeframes are shifting. I mean, they've always been long-term, I think, in things like fossil fuels, but still from, you know, I think we're sometimes looking at those quarterly or 3 to 5 year outlooks. And this is, you know, this climate risk is having us look through those 15, 20, 30 years down the line. But I promised I'd shift gears into kind of the, from a risk perspective, we might say the upside space. And this is the exciting green and sustainable finance market that is booming. I think got a huge boost as well through the pandemic, sort of the ESG market, but specifically in this space on green financing. I know TD's been at the forefront of green and sustainable finance space, bonds issued. I know you're looking into loans and other investment products. Can you take us through some of your main products and maybe a little bit on what's the business case for linking, say, loans to, in this case, to green or ESG outcomes? Is this, you know, how do you make sure that's not greenwashing? And are you giving a discount where it's deserved? Or tell us a little bit about how this comes together.
Yeah, no, it's a great question. And it is interesting how it's evolving. You know, if we were looking at sustainable financial markets, to use a catch-all phrase, and you were talking about this in 2011, we really just meant green bonds. And
Yeah.
similar to what we're experiencing right now with the sustainability linked, and I'm happy to explain what that is too, but we actually are having a moment in time where there's going to be a little bit of a cleanup needed, meaning that it's going to be inherent upon the financial sector to really instill market best practices here. We shouldn't be giving a unilateral discount to all of our loan books or across all products unless it's deserved. Now, the counterpoint to that is I would love nothing more as a structuring agent than to engage with a client that has a lot of long-term performance targets to boost their sustainability, because intrinsically we believe that that will make them a better credit over time. It'll make them more competitive. And so 5 basis points today is well worth it on the loan side to have a healthier, better, stronger, more competitive client down the road. But does that happen forever? I don't think so. And I think the market will need to get cleaned up. When we used to do green, social, sustainable debt offerings, loans, bonds, et cetera, it was really how do we tag something that the company's done on the CapEx side and give them potentially, per the market, a pricing benefit. What I like about the new sustainability link structures are we look at companies' existing sustainable performance targets or the targets that they're about to release. And in a world of net zero, we have quite a few obvious targets to choose from. And then how do we distill that, to Miranda's earlier point, into a bite size that's achievable, 5-year or 10-year term?
Right.
And we assess and we create key performance indicators with those companies to help show their progress against a forward-looking goal. To me, not only are these general corporate purpose instruments a more elegant solution to the normal capital markets practices and treasury operations of these companies, but they also actually incentivize forward future behavior in a way that the existing product suite didn't do. And so I wouldn't be surprised if a year or two from now, we not only see ESG linked loans, but we see more sustainability linked bonds. Sustainability linked derivatives are starting to become part of the conversation here. So this is going to permeate all of our different product offerings. And then what we're going to really do is we're going to start to see differentiation, I think, as the market knowledge base goes up. Am I getting more impact, more benefit from investing in this company versus that company? And this is where the push for standardization of reporting could really change the ball game here. If we can compare apples to apples, suddenly you know who's outperforming, and it's not a beauty contest. It's a binary outcome of who's doing well and who's falling short. That's where I think the cost of capital and the like could change. Just to bring that back, I think that's the next opportunity set in the next, let's call it 10 years.
So
Yeah,
so I just wanted to ask, so that on the sustainability linked bonds, so looking at that, not just use of proceeds, but enterprise level for full business model transition, do you think those supplant the single project investment type products that we've been seeing?
It's a great question. I actually like them both for different reasons. And I'll give you an example. I was speaking to a REIT this week, and they very specifically were saying, well, we are spending $150 million to build more affordable housing units in Canada. Terrific that they're doing that. But as a percentage of their overall commitment to sustainable, affordable housing, it's under 1%. They can't show year over year growth. So the ability to look at it on a forward trajectory, it doesn't look very compelling when you're growing by 0.1% a year. So that would be a great example of, let's use the existing green framework and do a green bond and highlight, or a social bond, pardon me, in that case. Let's highlight what you're doing. But I think there's room for both. I actually encourage treasury teams right now, if they have both, to keep both structures, because it gives them more flexibility and hopefully pricing advantage. Over time, though, it wouldn't surprise me to see sustainability linked formats significantly outpace the green, social, sustainable, just simply due to availability of assets. You know, CapEx is only meant to be so big for so long.
And that's actually wanted to build on that a little bit about the sort of the diversification of this space. I think in Canada, we're trying to be at the forefront of better defining a field that we're calling transition finance. A lot of labels, I know, but this is where capital could be allocated to fund business activities that are not considered green per se, so not maybe a wind farm, but that do reduce greenhouse gas emissions in an existing infrastructure, like, you know, electrifying machinery that currently runs on diesel, or repurposing old oil wells to become geothermal energy sources. I guess, Miranda, I'm interested in are these attractive to issuers in that space, whether on a project basis or sort of for a larger piece? What do these industries need? Oil and gas, agriculture, others that you're aware of, and what's the win-win for investors on something like transition finance? Or does that just sound like too much greenwashing, or is this going to be a legitimate space?
I think, you know, and as Amy pointed out, it looks like a legitimate space, and we need trillions of dollars here. So to have access to, you know, I'll say pools of transition aligned capital, that is really helpful. So it also helps from the issuer side. It improves the visibility on what you're doing. You know, I think, you know, similar to what Amy was just saying in her real estate example, it's something you get to talk about and show that there, you know, here's a tangible product that is getting me to where I need to go. It may just be piloting. It may be scalable to another extent in the future, but I think all of those pools are really important to get at.
And Amy, have you found, is there more supply than demand? Are you sort of making targets for sustainable finance and having trouble kind of actually dispersing those to clients, or is the demand there?
We're not having trouble. Demand is definitely outpacing supply.
Okay.
But maybe before I jump into that, I want to make one comment on something Miranda said. You know, I think on the transition file, especially given that we're speaking at GRI today, we do need to make one important distinction, which is transition is not just improving on your existing baseline. That's part of it. But when we talk about transition, to do a credible transition project, you're going to need to be aiming towards this 2050 net zero target. It's not just enough to improve because everybody's baseline is different. It's not as if you have a perfect comparable. And I'll be honest, a percentage improvement gets harder and harder the stronger your company is, right? So
Yeah.
you can have a huge percentage improvement if you're starting from a pretty low starting point. And so these external benchmarks, and this is why entities like Science-Based Targets Initiative are having such an incredible moment and so much success right now. It's why entities like PCAF exist and the Rocky Mountain Institute, and you're seeing most of the financial institutions sign up to be part of this. We're trying to figure out how we move this direction. And
Yeah.
so I just think that we need to recognize that transition has to be in the context of a net zero world, because that's what gives us that anchor in the future that we then look and say, okay, we're here, we want to get here, how's that done? Versus let's just improve, but we're never going to get to the end goal. And so I think, and that was a huge debate. I was actually on the writing group for the Canadian Standards Association, and that was a significant point of focus that I think can't be understated, especially in the Canadian context.
And just before I'm going to ask you a question on that, I just want to say I know some of the people in the room here, and I just can't believe how quiet you are. So don't let me ask all the questions. Please put something in the chat box or raise your hand. We'd love to have you join in the conversation here. We've got two of the leading thinkers in the world on it. I think two questions come out of that. I know Miranda, you wanted to respond. I think on the Amy's referring to something that's coming out soon called some principles and guidance for transition finance, which we're going to see come to the Canadian market in the next month or so. So this will be sort of a set of principles and some definitions in 8 sectors about what sort of would count as transition finance. And one of the big principles is you must be reducing greenhouse gas emissions, but you've got to have the context there that it's in alignment with that net zero target. I wanted to ask a question about the importance of transparency and reporting. Then this is all voluntary. It's as you say, it's sort of it's a new and emerging space. There's not a lot of standardization yet. The only thing I think that really grounds this is that level of disclosure, isn't it? And that level of sort of credible and maybe auditable data that you can really stand on to say that we have had the results that we intended, or we hadn't and we're working on it, sort of a thing. I guess that's a pillar to really make all of this market work today in the form that it is today.
Yeah, I do think so, and we talked about what do we need. That taxonomy is really important and critical. We need that. We need the framework around what we're talking about here, because we have green, shades of green, brown, SLB. I mean, it just keeps going on, and Amy, to your point, it needs to be cleaned up. And we need to understand what we're dealing with. But from an issuer side, one of the other things you get is an investor diversity. You're getting people who are very focused on these issues. They're very knowledgeable about these issues, and engagement on that level can really help. If you're using that, it can help with your business model as well.
I want to shift gears a little bit, still talking about markets, but this is, I think for a lot of people, transition is kind of synonymous with carbon pricing or carbon tax. And so I just wanted to talk a little bit, and this is an important part of the policy mix that we're seeing, not only in Canada, but worldwide. As we lead up to the COP26 meeting coming up in November, again, a global carbon market will be on the agenda. I don't know how much progress we'll make towards it, but from your perspective, and again, kind of coming from the issuer side, Miranda, from a finance side, do you welcome a clearer price on carbon? Do you welcome a carbon market, cap and trade? Is this beneficial? Maybe Amy, we want to kick us off on that one?
Well, I don't know if the beneficial would be my word. Inevitable might be the word that I'm going with. Look, the reality of it is that I wish there was a better tool, but the best tool we have right now globally is carbon. And at least from my seat, I don't see a scenario where we don't evolve to a place with liquid carbon markets that mimic a lot of our other commodity markets in the next 10 to 15 years. The challenge right now is that we don't have any differentiation. I mean, we talk about carbon offsets, and the entirety of the kitchen sink is in there. We have renewable energy credits counted in that. We have PPAs sometimes grouped into that. We have offsets, and then we don't even talk about the difference between an avoidance credit and a removal credit. And so, I think two things, and it actually ties into the question you asked before, which is we used to have not ESG reports, but corporate citizenship reports. And they were these beautiful, glossy, nice to haves about how many trees we'd planted in the volunteer hours that our companies had done. And suddenly we're entering a world where our ESG report is about to be audited. And so all of you on this line that are in risk seats are being asked to sign off on them. And there's liability assessed, and there's metrics that are quantitative that are being used. And so really when you look at companies making these goals, talking about carbon, there's going to be carbon accounting standards applied. And you can buy avoidance offsets to address your scope 2 and scope 3 emissions. But little known fact, you can't buy avoidance offsets for scope 1 emission reduction. You have to buy removal offsets. So there's going to start to be differentiation in the price in the market, at least from my perspective, in removal versus avoidance credits. And secondly, we have a market where you could have a let's call it a nature's-based carbon sink in a third world country. We have no ability to know if that is a unique carbon removal credit or offset credit. That could be sold 3 times over right now. So there's a lot of interesting development around blockchain, around the development of more liquid two-way markets. I mean, this is not going to be able to stay an OTC market forever. And I think when companies then look at how they show improvement, they're going to show it 2 ways. They're going to show it through operational improvements, but eventually it still takes a certain amount of emissions to make a widget, and you're going to also need to be buying these carbon offsets and removal credits to reach these net zero objectives.
Yeah. And Miranda, I don't see it in the press, at least. I don't see the energy firms really resisting sort of this price on carbon. How do they take this in stride?
Yeah, I'd say the other way, they're encouraging a price on carbon, because in order to spend the capital to meet these commitments, you need to know what the rules are and what it's going to cost you. And it's interesting, you wouldn't actually make a multi-decade, multi-billion-dollar investment in something without actually having some reasonable assumption on what your pricing was going to be. So, a lot of that right now is guesswork. It would be nice to have a framework that was legitimate, that actually helped us, but that's not stopping companies from moving ahead on a lot of these issues. We saw this morning Suncor and ATCO talking about blue hydrogen. And I think it was Mark Little in the paper said, look, I'm not going to wait for a 10-year regulatory process. We have to get on this. Yeah. And I thought, okay, it shows the level of frustration that's out there when they're making statements like that. But I think that's where everybody is right now. We've got to get going. And Amy and I were talking a bit about this with Nutrien Carbon. It might have been a little earlier. All the pieces weren't quite there on the pricing side of things. But you know what? Conceptually, we know that this is the right project and the right thing to do. And you can talk about the carbon trading aspect of that.
Yeah, maybe to just jump in there, I think that if you're sitting in, because we seem to be picking on the Canadian energy sector a lot, if you're a C-suite executive at a Canadian energy company or Canadian financial, I do think there's a lot of reason to be excited about carbon, because Canada has some of the leading technology in the world. I mean, if you look at the Quest project out west, that's a European oil major investing in Canada to set up a CCS technology. And really, when you're looking at carbon, you only have 2 options. You have nature-based solutions and anthropogenic solutions. And in Canada, the value proposition of anthropogenic solutions is enormous. It could be revolutionizing what happens in the Canadian energy industry as we transition. Because if you're actually taking carbon and trapping it underground, we can measure that very, very clearly compared to a nature-based solution. And I think that that's true. And on the agriculture side, just to play through the nature-based solution, you look at a company, just to go to Miranda's portfolio, Nutrien, what a great company. They have access to more farmers and more agricultural land than many other companies in the world. And how do we think about, could we do sustainable farming in a way where you could create a new revenue source for farmers, could create a way to actually generate carbon credits that could be traded? That's really unique. And there's a localized aspect to that that's very appealing for companies that are in certain markets. And same thing with our timberlands. If you're sitting at a pension today, you are some of the largest holders on the planet of timberlands. Those may be underutilized resources, or maybe they're being leased out to paper packaging companies. But is that going to be more valuable to let those trees grow and to turn them into carbon credits down the road? Maybe so.
You're actually hitting up right against one of the questions that have just come flowing in, and then I've got another person who we're going to unmute to ask a question. So I'm so glad people have, I think they've just been enjoying the dialogue between the two of you. I'm glad we've got some people joining in. One question is sort of following on what you were saying, there's a movement that may require investment decision makers, particularly in the pension context, to disclose the extent to which they take ESG considerations into account. So maybe to your point, maybe and this is apparently happening in Australia, France, UK, and Germany. Would this be a must? Would we like to see that in Canada? So investment decision makers disclosing the ESG lens that they've used in their decision making. Your responses to that, and then I'd like to invite Lois to come with her question.
Yeah, first, the ESG considerations, I think, should be integrated into the overall process. So I think we've gone from the point that good investors would always look at it because it speaks to the sustainability of the business model. And if not enough we're doing it, it's been ripped out and viewed as something separate, but it really is all part of the sustainability of the business model and how you're valuing the business. So I think it's fair to ask what areas that you're looking at, but I think we go back to what is a material risk. And we were talking about disclosure before. It belongs in your MD&A. So if that happens to be climate, if it happens to be social, if it happens to be supply chain, if it happens to be cyber, if it's material, it still belongs in your MD&A, and it should still be then auditable, and you're accountable to all that, and all that information is decision useful as well. So yeah, now I lost my train of thought.
Well, we've come so far with that
maybe
materiality section. I think Amy was saying it earlier. It used to be about sort of, employee volunteer. ESG was more, it's come to about those material issues that have an impact on the future profitability of the business.
Which are table stakes, right? I mean,
Absolutely.
One, it's a requirement, and then anything over and above that relates to that is table stakes. It's not just what's best in class anymore.
Yeah, it's funny. We spend a lot of time talking about that too. Table stakes are evolving quickly. Things that used to be a reach are now considered business as usual. And I think that agree on the ESG reporting file without question. If I'm sitting in a Canadian pension, well, first off, we have two things. So Canadian pensions, I always laugh that people call them Canadian pensions because you're all global pensions. You are some of the largest asset managers and asset owners on the planet. So while I appreciate the Canadian emphasis, I mean, if you look at the global pension landscape, there are a few that are top 5 globally. I mean, we're talking about a select club where you have CPPIB rivaling APG and HKMA, and in the Monetary Authority in Singapore, the Temasek assets. So we're really in a unique situation now where you're global investors. And so if you're seeing the winds of change in, let's call it Australia, France, et cetera, which I agree are happening, you're going to not go and work as an institution to the lowest common denominator. That would be silly. We instead look and say, what's the most stringent? And once you understand how to do that institutionally, cascade it across your business, because then you're going to be ahead of maybe where the country that you're domiciled in is at that moment. And that'll put you in a better position longer term to really stay at the forefront of what's being asked of you.
Yeah, absolutely. And that disclosure question, whether it's, investment decision makers talking about how they take ESG into account, or just improving the overall sort of material disclosure. And we've seen this through the task force for climate related financial disclosures sort of coming to the forefront. But this, I expect, will expand across other issues, not only climate, but into biodiversity and some of the social and human rights issues across the board. These will start to become sort of standard, as you say, standard play. Again, just welcoming anyone, put your hand up or type into the chat. We'd love to hear from you. What is your burning question? You've got the opportunity to shape this dialogue. As we sort of come to our last few minutes, I thought, while I'm waiting, I'm trying not to pause too long, but please don't delay. Oh, I have one. I'm so excited. Lise.
I'm not sure it's a burning question, but it just, I thought about it when Madame Hubb mentioned that one of the risks is that maybe some companies would want to go private to kind of go in hiding. I thought, well, if the major financial institutions are starting to divest and private equity and institutional investors are looking at ESG, is there a risk that at one point, where will the capital come from for this company to go private? I know it's not a short-term issue, but I would imagine that it could be a risk further down the road, or maybe not. I'm asking the question.
Yeah, I think it kicks the can down the road. I think it is really all it is. It's delaying the inevitable, but it's a place to buy time. Because if the cash flows are strong in the near term, there are those that would value those in the interim. But what I think that in the context, it's really not solving any greater problems if that's the behavior. Yeah, it's the unintended consequence of some of the policies and divestment issues that are going on right now.
So you don't think it would be an issue of finding that capital to go private?
Not today. And again, I think over time, but that could be a while.
Yeah, so there's some argument to say you kind of want those public firms to still be at the forefront here, because then we've got access to greater transparency and engagement and all those opportunities. So just to say that the mics are unmuted, so please feel free. We don't have to ask us to speak. You can control, you can mute and unmute your own mic. So I see Rita.
Yeah, hi. So my question is for Miranda, but Amy, feel free to jump in. What are some of the tough nuts that we need the government to crack for us? Both at the federal level and the provincial level, particularly out west.
Yeah, I think from a regulatory standpoint, the price of carbon is the big one. With respect to other things that as we watch Enbridge Line 5 and pipelines, and I think those are separate and apart from the actual investment decision. But if we can't get regulatory certainty, you're not going to get investment. And if you can't get regulatory certainty, then you do have a terminal value issue from your investor base. So I think let's start with carbon and understanding the incentive frameworks. I think CPA is doing a lot of roundtables on this. We have the Business Council of Canada. The discussions are going on about not leaving the government with a blank page to fill and figure out. It's putting the companies together and saying, this is what we require, and putting it in front of them. And that may be a better solution than waiting for them to try to fill that blank page and figure it out. So I think these dialogues are accelerating as we go through.
I was muted myself. I think it's a really good point on just getting that regulatory clarity and government pathway and vision. Amy, TD is a global firm, and what are the one or two things government could do that would help you accelerate on that path to net zero? Oh, you're also muted.
Sorry. In Canada, I agree. I think a price on carbon, actually in all of North America, would be really useful, very helpful. I also think that in the US, there's obviously a tradition of tax credits. The 45Q credits have gone a long way to giving companies and the comfort they need to invest in new technologies. And if you look at the path to, let's call it profitability of some of our renewables businesses and technologies, a lot of that was done on the back of government support early on. And so I think, if you look at solar and also wind, it took about 30 years for those businesses to actually come in line and be profitable vis-a-vis traditional fuel sources. When you look at things like hydrogen, be it blue, green, et cetera, or you look at other technologies that are coming down the pipe, CCS being the primary one in my mind, if there was tax incentives from the federal government to do that, or at the provincial level, that changes the game. And I think, anything that we can do today that speeds this process up puts Canada and puts all of North America in a more competitive position longer term, because then we become a global leader.
I think that's exactly what you've hit it on the nose. It's a competitive issue at this stage. And Canada actually has a lot to offer in this net zero future, and a lot of it, ironically, coming out of those oil sands we've been talking so much about, where a lot of the expertise sits. And CCS, you've referred to a few times, carbon capture and storage, one of those technology solutions we need to literally capture carbon out of the atmosphere. I think we've
So,
got time for a last question. Oh, yeah.
Thanks for that comment, Amy. And just I would highlight for our audience at Sonia that Peter Van Dyke, one of our executives in residence at GRI, wrote a really good paper on tax incentives and other government initiatives that would help on this. So I encourage people to access that on our website, because we're in total agreement. One thing that I'd love for both of you to comment. You know, this has been on the agenda in other sectors, in the energy sector, et cetera, for many years. In the financial sector, it feels like it's gone from 0 to 100 in the last 6 to 12 months. And one of the things that I would observe is the number of areas of focus are accelerating. And there really seems to be a bit of a lack of expertise within the financial sector. What are you seeing, and how do you envision us really getting the financial sector up to speed, both, you know, within risk management ranks, across business units, and all the way up to boards, frankly, you know, as we start seeing things like say on climate, you know, the question of, do you have the board expertise to assess where your organization's going? So I know it's a bit of a big question, but this whole issue of people seems to me like it's become quite a pressing one, and knowledge and expertise pretty quickly.
So maybe I can take the business aspect, and then I know Miranda will have views on the board side of this as well. But for us, you know, I think that we do need to start bringing in external expertise. Historically, we had our environmental teams at TD Bank Group that were really amazing when it came to things like climate, and they know the strategy to get to net zero, but we haven't had necessarily that expertise built into our risk management function. So we're working on that now. When we look at our overall business, I think a big disconnect is that the business doesn't have environmental knowledge, and our environmental teams don't necessarily understand fully how the business works. And so there has to be, whether that's through secondments, whether that's through external hires, I think there has to be a focus institutionally on bringing up the standard of education. I think in my team, when we were instructed, we've done something like 25 internal teach-ins with every single sector to try to raise the bar of knowledge. Also, we've hired external environmental specialists. I've got plenty of people that know how to make a model or price a bond. I need people that understand how to price carbon risk. I need them to come and work for our firm. I need them to work for my team. You know, how do we look at an M&A transaction and model in emissions over the longer term? That's where this is going. I think at the board level, we've actually done a number of board presentations this year. And, you know, I think that boards are showing a huge amount of interest in bringing in external expertise to try to boost the knowledge. But it's very clear that there's a focus on having ESG expertise built into senior leaders, whether it's via compensation or the like through policy and governance. But also at the board level, I wouldn't be surprised to see that evolving as well.
Yeah, and I will say, Amy, you're absolutely right. The boards are bringing in all types of external expertise. And Sonia, you mentioned that the amount of information has exploded that's out there, but also misinformation, and not apples to apples. We got apples, oranges, and bananas that we're trying to compare and trying to understand. And, you know, even step back a second on the incentive discussion, we need to understand the numbers. If we're asking for incentives, what does it cost to either forego or take a ton of carbon out of the atmosphere? From a CCS perspective, from an electric car incentive perspective, you know, where is the money best spent? And sometimes the political agenda will override that, you know, from a perception standpoint, but we need to still understand what the economics are. And I don't think that's really widely understood yet among all of us.
Maybe I could just make one more comment, because we have so many senior leaders on this call, but senior support for this topic to be done correctly is paramount. I can't tell you how there are less people that know what they're doing than seats to do it right now. And so, you know, taking an oil and gas banker who was disintermediated amidst COVID and painting them green and pretending like they suddenly know about ESG, that's not going to work long term. And I think the market and our clients are starting to see through that. And so and the contrary then comes, which is it's not inexpensive to want to bring in environmental expertise. But if your individual institutions are standing up ESG teams that don't have a mix of business and environmental expertise, that should be a big flashing red warning sign to you. You know, we need to have balanced teams. We need the business people to teach the environmental people and vice versa. So I think that that's something that only gets accomplished through senior support.
I think you couldn't have ended on a better note, and that's exactly who we've got around the table and who I think are inspired to help build out the talent and the vision for this sort of net zero future. This is the worst part of my job, and that is bringing this event to a close as we've come up on the noontime hour. We've used up our time, and I want to respect everybody's day. I know people have to get off and get on to other things. I can't thank you enough, Amy and Miranda, for joining us. Your experience and your insights have enlightened all of our perspective on net zero and the wider ESG activities in the financial services space. Thank you all so very much for joining us at GRI this morning, and we just can't wait to see you again at our next event. So round of applause for everyone. Thank you very much. Really appreciate it. Have a great